Today on InvestTalk, we talk about high and low cost of living states, and we unpack Roku. It's down big from its high, but should you buy it now, even though it still loses money?
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Thursday, July 11th, 2024 edition. I'm Justin Klein, and the objective here is the same, which is to help you achieve your own version of financial freedom by giving you actionable material, the right data to pay attention to, and the right perspective, the right frame of mind that you need to make good decisions with your money. One that keeps emotion out of it and focusing on the facts at hand. Getting rid of as much bias as you can. No one gets rid of it all, but trying to eliminate the natural bias that comes from your life experience, right? Whether, which political leaning you might have, what type of lifestyle you grew up, whether it was wealthy or poor or middle class, all of that has an impact and more on the way that your thinking is framed. So we're here to help you reorient that thinking, to try to get rid of that bias, get rid of that emotion, and simply focus on the facts that are in front of us. How the world is, not how the world, not how you hope the world to be. Okay, so that's what this show is about. I'm not Kramer. I'm not going to bang bells and whistles and big red buttons. That's not me. Because while I hope you're entertained, most of all, I hope that you're educated. Right, Kramer, his main job is to educate, is to entertain, because he needs ratings. He needs eyeballs. His main job is not to educate. That's why he has bells and whistles, right? Big buttons. We don't have any of that. This is getting straight to the point. And we will talk about today's market performance for today, as well as run down the show topics. But as usual, we are going to get to our first caller question now.
Hey, Luke and Justin, Phil from Philadelphia here. Wanted to call about Roku, ROKU. Wanted to see what your thoughts are on purchasing some shares at this level. It's around 61 or so. I'd love to hear what you guys think. Thanks a lot.
What was the lesson Steve always gave, and my grandfather always gave, which was don't buy companies that don't make money. And Roku has had a lot of hype because it's always had pretty good top-line revenue growth. And a lot of people focus on that. Oh, look how much more money they are bringing into the door. And while that's fantastic, and they've done a great job. In 2017, their trailing 12-month revenues were $436 million. Now it's $3.6 billion. Huge growth in the last 7-8 years. Well, what does that look like when it comes to profitability? Well, they were minorly profitable during the pandemic when everybody was home watching programs on their Roku. And since then, their profitability has rolled over considerably. Now, it's getting a bit better, but they're still trailing 12 months losing $566 million. Now, you can say the best argument here is free cash flow is positive. That's good. But based on the market cap of $8.7 billion, that's not a great free cash flow yield. And this is a company that continues to issue more and more shares, diluting the shareholders. So, and then if you look at profitability, return on equity, negative 23%. The 5-year average is negative 10%. And the chart is terrible. It peaked around $110 back in December. Now we're at $60, call it $60 and change today. And it just continues to head lower. So the technicals don't line up. The profitability metrics don't line up. The only thing positive is that free cash flow, but that backs out stock-based compensation. That's not including, stock-based compensation. So until they rein that in, then I don't pay much attention to that free cash flow. I look at that profits, those profits. I look at return on equity. I look at the shares outstanding continue to go up. And they all are very, very poor. So absolutely stay away from Roku. Now let's go to our first live call from Dan in St. Louis, looking at MALRY.
Yeah, it's Mineral Resources Limited.
Okay. And why? Tell me more about it. What do you like about it?
I was listening to a podcast today, and they basically premised the podcast by talking about how this one company for the past handful of years has beaten the S&P 500, and that got my interest. And they were talking about this company, obviously, and they, from what I understand, they mine. They're like half a mining company and half a construction company, and they kind of create their own workflow. From what I understand, they mine lithium, iron ore, and natural gas. And they have like two facets of their business. One's like the mining side, the obtaining the resources side, and the other one's like once they find where they're going to mine, they create the work. So they're kind of like, I forget how he phrased it, like punching their own ticket or whatever for work. Anyway, I was just intrigued by it had 5 stars on Morningstar. It just seems, and it seems like a possible growthy name. That they're out of Australia, so they'd be dealing more with like China for their resources and whatnot. So there's that. But yeah. That's kind of what I was looking at. Okay.
Morningstar does give it 5 stars, but remember that is just their quantitative metrics. That's not looking kind of at the whole picture. And that is one of my worries here is that they are very focused on Western Australia. That's where they mainly operate here. And I think that number of like, they've outperformed the S&P over the last 3 years. Well, that's because they had a big move in 2020 into basically late 2021, and it's actually down from the late summer of 2021 until today. It peaked out then around, $44. It did chop around and go up to 67, but now it's down to 38. So it's certainly been in a downtrend, heavy downtrend, 667, which was early last year. And it's operating in, I like that it has a bit of diversity in its operations. Where, like you said, they mining, construction, and all that, and servicing. But ultimately, it's about really focused on their iron ore and lithium business. It looks like to me, and so and that is going to be heavily reliant on the Chinese economy, which I think is going to struggle longer term due to demographic issues, debt issues, and poor just governance there. So I don't like the trends in the chart. I don't love the lack of diversity geographically, just being so tied into Western Australia. Their profitability is okay. Return on equity is 9%. Now, it did go all the way up to 62% in 2019, 2020 in that time frame. But since then, it's just gotten worse. And this is kind of near the long-term average of profitability. If you go back I have data going back to 2007. So, I just think there's better use of your capital. I think there's better mining plays that are out there, more diversified, and frankly, in types of minerals that I rather own. Right? I'm not a huge fan of lithium because it's so abundant and it's just easy to bring on new supply when prices go up. That's why Albemarle, one of the largest in the world, continues to plumb to new lows because guess what? Lithium, even though EV cars are still flying off the shelves, especially in China, the price of lithium continues to go lower because of so much development of new mines. So I think lithium is poor. Iron ore is going to be very reliant on the steel production, right? And obviously China has issues there with their real estate market. So I don't love this. There's some things I like about it, but not nearly enough to check enough boxes to get me to buy it. Okay. Thanks for the call. Now we're going into a short break, and on the other side, I'll run down today's planned topics and talk about today's market activity. Please remember you can call anytime and leave your question on the InvestTalk voice bank. If you're listening via the live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART. Steve from San Jose, hang on. You are up next.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Let's go talk to Steve. He's in San Jose looking at FEPI, which is an ETF. It looks like a FANG ETF. Do you own it or looking to buy it?
Looking to buy it on a pullback.
Okay. Why is that?
Well, it's a covered call ETF, and I like the monthly income.
Okay.
And I'd just like your opinion on it because it has a huge annual, like 25% return.
Okay.
Or payout, rather.
Payout. Okay. Well, you know, it's selling calls probably are on companies that are have high implied volatility. So you know that's really the issue, or really what's bringing in that income. And remember, the income on these covered call ETFs, the income isn't really the same as what you get from a traditional investment. Okay. Because it comes with a lot of added risk. And if you look at the performance, and let me show you the performance, it's up 15% this year. But what are the Qs doing? For example, they're up more. Now, this is probably a lower risk way of playing the tech stocks, right? The FANG stocks, because this is the Rex FANG and Innovation Equity Premium Income ETF. So it owns, top holding is Tesla, by the way, down over 8% today. AMD, down big today. Intel, Apple, Amazon, Meta, Salesforce, all these companies obviously down today because there was a huge reversal in the tech stocks. So, if tech stocks continue to go up, this will, still probably do fairly well. But obviously you're exposed to these names in a big way, and it doesn't hedge you completely to the downside. So what I say always with covered call strategies of any kind, you have to look at the underlying asset and whether you want to be in that one or not. And so don't go chasing this yield, especially because this yield has only been around for a short period of time, right? And what is the true yield? It's all over the place. Okay, if I look at the distributions, it ranges from about $1 to $1.20. Okay, each month, which is a lot, but it also hasn't seen a big downturn in these stocks. So I don't have a problem with it as like a small portion of your portfolio, but don't be thinking you're going to get this huge yield with low risk. This is not low risk. This is still very, very high risk because of the very high concentration in these large cap tech names. And as you saw today, right, with the big drawdown in tech. So it's okay for a small portion, but not much. Okay.
Appreciate your input.
No problem. Now here comes a quick break. Then finally, I'll run down today's show topics. But I'm ready for your calls at 888-99-CHART.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next InvestTalk podcast.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Let's go talk to Don. He is in Orinda, California, and wants to talk about bonds.
Yes, sir. I have a brokerage account that is generating cash, and I'm trying to figure out the best place to allocate. I'm looking at. I typically purchase dividend-paying stocks.
Mm-hmm.
Because of capital gains and the 15% taxes.
Mm-hmm.
Is that better than, or should I also augment with bonds, the income from there being at ordinary income?
Well, that depends. You are here in California, correct?
Yes.
Okay. So you could buy treasuries, right? And there's some there's tax advantage there, right? State tax free. So that's something to think about. But dividend-paying stocks are more risky. It depends how much risk you want to take, right? Bonds in general, as long as they are, especially relatively short-term, then you are, you're going to take less risk than buying individual stocks. So it really is more about your overall portfolio. It's hard to say because I don't know what else you're in. A dividend ETF. They're just using like a dividend ETF, dividend fund, like a dividend.
Yes, I actually I do have a lot of cash in an ETF.
Okay.
But typically I do individual bonds and I do individual stocks.
Got it. Okay.
And so I'm, Yes, I do have it out with just a short period of time.
Yeah.
On my bonds.
So I would say I would really have to look at your overall portfolio, what type of risk you're taking, et cetera. Yes, bonds are lower risk if you're buying the right type. But there's nothing wrong if you have a longer time horizon to buy dividend-paying stocks and dividend-paying ETFs. What you don't want to do is do that just because of the tax situation. And this is almost the number one mistake I see most investors make is they do things with taxes in mind only. That's all they focus on. Okay. And so what you want to look at is the overall portfolio, what type of risk you're taking, what type of weightings do you have to different sectors, for example. And are you overweight or underweight? Maybe buying more dividend-paying ETFs is going to expose you to sectors that you're already overweight, for example. So these are the things, if you want to do a portfolio review, I would encourage you to do that. Head over to our website. We can run an analysis and give you some reports on, what is that exposure? What does that look like? What type of risk are you taking? And with new cash, how should you deploy it? Should you buy more bonds? Should you buy more equities? And that's the way you want to think about it, as a holistic picture of your entire portfolio.
I understand. All right. I appreciate that. Thank you very much.
No problem. Thanks for the call. Now, we have a lot of ground to cover over the next 30 minutes or so, a lot of calls to start off the show. And time permitting, we'll get to all of it. Our main focus point is about high and low cost of living states for 2024. As we navigate the current economic landscape, it's crucial to understand the stark differences in cost of living between the various states. So we will dig into that story. Also, with the way the odds are stacking up right now against President Biden or whatever Democrat likely replaces him, I do think that he will step aside. There's just too much pressure, both internally and externally. And, probably happens in the next couple of weeks is my best guess. But either way, the odds are good that we will have another Trump presidency. This is not a political, whether you want it or not, it's irrelevant. As I said at the top of the show, it's all about what the facts on the ground say. And if there is another Trump presidency, you have to start to think about what the economic agenda will be. And it's really not clear. There are your more populist Republicans and your more traditional Republicans. And both sides have different views of how the economy should be run. And there's a battle between those two. So we're going to talk about that and see which side will likely win out. Also, passive investing and how the AI bubble is really being fueled by passive investing. And now, big change today, but I want to talk about that makeup and how that's impacting the market structure that you're seeing on a day-to-day basis. We also have some voice bank questions ready to play for you from callers that called in and left their question. We also have questions submitted via the YouTube channel in the comment section, so we will get to those. And of course, most importantly, it's about you and your finance and investment questions. So we encourage you to call right now at 888-99-CHART. Now, on the next Invest Talk, we'll look into the story behind this headline: 6 best high interest earning strategies for 2024. There are several effective high interest earning strategies, including high yield checking accounts, money market funds, CDs, and bonds for investors to explore. But you have to understand the benefits and drawbacks of each option to make sure you're making an informed decision to optimize your returns and grow your wealth, not just in the next year, but for years ahead. That story tomorrow, but for now, I'm Justin Klein. I'm ready to take your calls at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success.
Let's go talk to Frank in San Rafael, and he's looking at First Watch Restaurant Group, FWRG. What's getting you excited about this name?
I own it, and I'm down 30%, so I want to know if I should get out of it.
Yeah, probably. It's a name with not great profitability. Now, it is profitable, I will say that, but earnings are supposed to be flat this year. Estimates for next year's earnings are being downgraded. And it's still trading even after this drop of 39% from its 52-week high. It's still trading at about a 30 to 40 times forward-looking multiple, depending on how that comes in. Earnings last quarter were down 20% year over year, and that's not expected to improve over the next few quarters. So, they have a good balance sheet. That's good. Their free cash flow is positive, but only barely. It's a small cap name. They operate 524 restaurants in 29 states. They're out of Florida, but still only about $1 billion market cap here. And, I just don't love what I'm seeing on the chart or in the business overall. So, recent IPO in 2021, and as typical, these IPOs tend to not do so well over, the first few years, until there's a really capitulation event. And I'm not seeing that quite yet. And you continue to see the number of shares outstanding march higher. That means, they're diluting you, the shareholder. And that's another reason why this stock continues to head lower. So I think you should just take your lumps, take your losses, and move on.
Okay, thank you. Been listening to you for at least 6-7 years. Thank you.
No problem. Appreciate you tuning in and spreading the word. Now, let's take a look at the market today. It was an extremely interesting day because you saw the mega cap, FANG names, tech names really falling out of bed. You had NVIDIA down 4.7%, Tesla down 7.8%. You had Palantir down 2.7%. What were the other big losers on the day? So those are the main ones. AMD down as well. But you had, so overall large cap growth was down 1.5%. Small cap value, though, up over 3%, 3.15%. That's one of the biggest changes I've seen, biggest divergences in markets that I've seen really in years and years. And I think this is the start of the end of the really move in growth stocks. I think you're going to see a Fed rate cutting cycle. That is one of the reasons for this move. There are two reasons. One was the inflation data came in lower than expected. Month over month, CPI was down 0.06%, and year over year went down to under 3%, from 3.27 down to 2.97. You had the core. That was roughly flat, but that did decelerate from 3.41 year over year to 3.28. And there's just a lot of indications here that inflation is fine. It continues to ebb, and there's a lot of pressure to the downside. And so it's giving clearance for the Fed to really continue to or start to cut rates in the near term. And if you look at the odds markets, that has moved up for, let's see, the month of July, and we have a Fed meeting in July at the end of this month, the 31st. Now that's still looking like a pause. No rate cut in July. But September is now up to 84%. That will be one cut, and an 8% chance there'll actually be two cuts by then. And only a 7.3% chance there will be no cuts between now and September. So I do think September is the month they move. Typically, the Fed likes to really signal that at the previous meeting. And so that's why I don't think there will be a cut, because they haven't signaled that quite yet. But at this meeting, they will likely signal a cut in the month of September. In addition, you had the Bank of Japan talk about maybe announcing changes to their policy at the end of the month. And that moved the yen up pretty dramatically and the dollar down. So you really saw the commodity side of the market really ignite. Small caps are up 2.6%, where a lot of those commodity names are. Gold moved to the upside and close to a new high. Silver, same thing, back to the highs we saw in late May. So really, this was a monumental day in markets, and you definitely need to wake up to this shift if you get follow through. Now, it could just be one day. You never know. You can't say with 100% certainty that this was the day that things kind of shifted. But something I sent out to our clients just a few days ago, which was, the first half of the year was really dominated, especially the second quarter, with AI plays. And if you weren't in AI, really, the equities kind of chopped sideways. And I expected a shift in market leadership in the back half of the year due to that Fed rate cutting cycle, a weaker dollar. And that's what you're seeing now. And that means, those more industrial names, commodity names, energy names are likely to find their footing once again. And that kind of poor market structure that's really pushing more dollars into the NVIDIAs of the world is coming unwound. And I think that's going to really have a stark impact or a major impact on markets in the back half of the year. And today, I think, was really the beginning of that. So pretty big day in markets, and it'll be interesting to see if we get follow through as we close the week. Now, our main focus point is about cost of living. High cost of living states versus low cost of living states. And this is coming from Forbes. And what they looked at were essential expenditures, such as housing costs, transportation, healthcare, food, and income taxes. And this is based on publicly available data. There were some of the big takeaways. Most expensive place, based on cost of living, Hawaii. The cheapest was actually Mississippi. Okay, talking about $55,491 for Hawaii and $32,336 per year for Mississippi. That's the difference in essential expenses each year. Okay, Washington had the 8th highest cost of living nationwide at $47,231, but it had the most disposable income because residents made a good amount of money. Okay. So it's not just about cost of living. It's also what is the available disposable income you have after paying for that cost of living. Okay. So Washington was first. Surprisingly, New York was second in disposable income and just over 29,000. Then Virginia, Connecticut, Massachusetts, Colorado, Illinois, Maryland, Minnesota, and New Jersey. So I like this list because it's really about looking at both sides. Because if you make a lot of money, right, you have a lot of economic opportunity around you, you can pay for that higher cost of living and vice versa. Okay. Like I said, Hawaii has actually the lowest disposable income because it's expensive to live there and, right, the incomes don't match up. Okay. An interesting state was Nevada. Cost of living ranking was 17th. So pretty high up there. Doing okay. But its disposable income was down near the lowest. It's at number 47, $17,277. Showing that, hey, yes, it's cheap to live there, but the economic opportunities also don't really match up. And that goes to the average salary per state. Massachusetts, number one, $80,329. New York, second, $78,624. Washington was third. California, fourth, $76,960. Surprisingly, Alaska was 10th, $69,888. And there's a lot of subsidies there for people that live there. So pretty interesting list here. Now, transportation costs. Hawaii, number one. California, number two. We talk about that all the time. The cost of gas, a lot of that is the gas tax. And so that was actually second. Alaska, third. Nevada, fourth. Washington was fifth in that ranking. What was the cheapest? Rhode Island. Makes sense. Small state. Easy to get around. Connecticut was second to the lowest in transportation cost. So I thought that was interesting. What about home? So what about home monthly mortgage payment? The highest was, as you would guess, Hawaii, $5,000. The lowest, Mississippi, lowest was West Virginia, $930. Mississippi was second at $1,031. Then Oklahoma, Arkansas, Louisiana, Kentucky, Iowa. So some pretty interesting takeaways there on that front. When it comes to rent, Hawaii was also top of the list. Second was California, New Jersey, Massachusetts, and New York. Those are the top five. The cheapest, North Dakota, Iowa, South Dakota, Kentucky, and Arkansas. Cheap places to live. So pretty interesting. Expensive food. Alaska was number one. Hawaii, number two. California was number three. Washington and Oregon. Those are the five most expensive states when it comes to food. So a really interesting breakdown here. So there's actually a link over on our website to this article. And it really is really enlightening to see which states it's expensive to live in, as well as which ones are cheaper. Now, we have quite a few live calls today, and we love it. But let me see if I can squeeze in a YouTube question here. This comes from Selena Marie 6220. Says, I'm looking for a small cap Canadian oil play. What are your thoughts on BTE? BT, I like it because of its revenue growth, share buyback, growth potential, increased production, and decrease of debt. If you like it, what would be your entry point? Now, it has pulled back from around $4.60, hit a low in February around $3. Now it's up to $3.74. Let me pull up some of the fundamentals here so I can get my eye on that. And it is a small cap name, a $3.1 billion market cap. It lost money last year. I don't love that. Earnings supposed to be 32 cents this year, 41 cents next year. So forward-looking multiple around 9 times. It's okay. Let me look at another piece of software that gives me some more insight into its profitability. Give me a second to pull that up. Yeah, it operates in Canada and the United States. Okay, mainly Western Canada. They do have a good amount of debt in their balance sheet. I don't love that. Enterprise value to EBITDA is at 7.5. My issue is I just think there's better plays that are out there that have better relative strength. The relative strength here is only 42. I don't hate it. I think it's fine. I just think you have better opportunities elsewhere that are a bit bigger, a bit more diversity, and a better balance sheet. So I would keep looking. I like the direction you're in into the Canadian oil plays, but I would find another one. Now let's play another voice bank question from 888-99-chart.
Adrian from Texas. I wanted to diversify my portfolio and enter a defense play. And I wanted your thoughts on ticker symbol NOC, Northrop Grumman. Looks like they've increased their debt over the last 8 years or so, but their profits have gone up, but just kind of minimally in comparison. So I wanted your thoughts on if this was a good place to look at or if I should maybe go elsewhere. Thanks.
All right, looking at Northrop Grumman, and this is a large defense contractor, and most people know they're in charge of the F-35 program, for example, and the B-21 bomber. And so they're part of the military-industrial complex. And I've said this a couple years ago, and frankly, I've been a bit wrong on the direction of spending on military. It does continue to go up. Now, it is falling as a percentage of GDP, but it's not. They're not doing it actively. They're still growing defense spending in this country. But what I worry about kind of longer term is just the debt, right? The amount of debt that we have on our balance sheet, the cost of the interest on that debt, and will that crowd out other expenses? Reforming Medicare and Social Security, for example, and maybe trimming some military spending. Now, with geopolitical risks kind of rising with what's happening, obviously in the Middle East, as well as Eastern Europe, and potentially anything with China, although I think that risk is a bit overblown. You could have these issues that continue to kind of rear their ugly head. But if the fiscal situation continues to spiral out of control, probably a good way to say it, there's likely to be some comeuppance and some cuts in the military sector. And maybe that's what the market is pricing in here, because Northrop Grumman is still very profitable. Earnings are supposed to be up big this year and next year, although those estimates are coming down. And if you look at its profitability, it's still good. 14% is its current return on equity, but that has come down from a high of around 35% in 2021, but more in line with its longer-term profitability. So the debt has been going up, but it's not really an issue compared to the size of its cash flow and its revenues. I don't really see that being a problem. The dividend, about 2%, I think that'll continue to be paid. But I don't love the technicals here. So I just don't like the backdrop. I don't like the technicals. Return relative strength is 23, very, very low, below all the major moving averages. So I would not be using this name to diversify my portfolio. I would be looking elsewhere. This is InvestTalk. I'm Justin Klein. We have one goal each and every weekday, and that's to help you achieve your own version of financial freedom. And we do that by answering your finance and investment questions, which we will continue to do after our final break. So get your questions in now at 888-99-CHART.
Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Now, the odds of another Trump presidency, based on what we see over on polymarket.com, is about 60%. And there's about a 70% chance President Biden will drop out of the race, and a 51% chance Kamala Harris will be his replacement. So things can change, obviously, but I'm a firm believer that this is kind of an emperor's new clothes situation where people can't unsee that debate, and there will continue to be push from the inside and the outside to get Biden out of the race. And who replaces him, I think, will certainly impact those odds of a potential Trump presidency. But those are really the facts on the ground, whether you like the situation or not. You really have to the market will start to look towards what does that mean for economic policy under the Trump administration. And it's not clear cut. A lot of people think it is, but the reality is there's a lot of infighting between your old standard conservative Republicans that really are more libertarian, right? Like free trade, lower taxes, etc. But there is a new wing of the party that continues to gain prominence, and that is, if you think of the populist right, the new right or the populist right, and there's an annual meeting of the National Conservatism recently, and they condemned the corporatist right, the free marketism, the globalism. And they are disenchanted by the wars in Iraq and Afghanistan, illegal immigration. They discredit globalization, and they don't want international intervention in our economy. Okay? And this has become a big part of the Republican base. And you even have major candidates for VP, such as Marco Rubio. And who's the other one? Marco Rubio and there's one other one. I'll get to that in a second. But Marco Rubio recently said that he is pressing the GOP to become more pro-worker, less reflexive to pro-business, and criticize things like stock buybacks, and wanted to continue to expand the child tax credit and implement industrial policy, which obviously is not a very free market. And they want to focus more on manufacturing here in the United States, thus why tariffs are a big part of the policy platform. So there's the battle going on because these people are more interventionist. They don't want corporations to get into things like DEI and climate change, right? Which is typically something that the left is doing by criticizing corporate action, for example. Okay. So Marco Rubio said that, and that's the other one. J.D. Vance, another VP candidate out of Ohio, he actually praised the current the Federal Trade Commission, FTC chair, Lena Khan, for taking on big corporate mergers and big tech. He says, quote, "We should start with this question. Why should labor ever be taxed more than capital?" End quote. Actually, that was Senator Josh Hawley. Said that this week. That's typically a left talking point, right? Think of private equity and the way carried interest is taxed. And now that's starting to become a bipartisan issue. So the whole supply side economics mantra that really started with Reagan in the 80s is starting to come undone. There's a lot of infighting within that party. And which camp will prevail? It's hard to say because famously, Trump is very transactional, not really ideological, and he has advisors from both camps. And I think a big question will be, who does he pick? A Rubio or a Vance? That would be an ode to the new right, the more populist right, if he picks them as a VP, versus the leader in poly market is actually Doug Bergman. He's up there as well, along with J.D. Vance. So I don't think it's as clear cut to say, hey, you're going to get major tax cuts and deregulation and your typical Republican economic agenda. It very well could be a lot more populist because that part of the party has certainly grown over the last 4 years. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And check out our YouTube channel over there on YouTube by searching InvestTalk. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.